is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning. Welcome to Bloomberg Surveillance. This is the Early Edition. I'm Danny Berger in London. Here's what's coming up on today's program. When the chips are up, European semiconductor stocks jump after Nvidia hypes its sales outlook on strong demand for AI processors. Shares in the world's most valuable chip maker soar after hours. Credit Watch, the debt impasse could hit America's AAA rating as Fitch warns of a potential downgrade, but House Speaker Kevin McCarthy is optimistic about a deal. Plus, private credit is booming in the wake of the recent banking turmoil. Apollo Asset Management's Jim Zelter joins us exclusively to talk about opportunities in the funding market. First, let's get your check on markets. And if it wasn't for the AI story, if it wasn't for Nvidia, it'd be a difficult day for risk. European stocks down 0.2% about an hour into the cash trade. If you were to just look at some of the European chips, though, you'd see a different story. That's also reflected in NASDAQ futures up 1.5%. Post-market, Nvidia was up some $200 billion worth of market cap after showing that strong demand for AI. Price to sales, though, was something like 30 times. So still very richly priced. Euro, we had some German data out. Germany in a technical recession in the first quarter, the first time since the pandemic, citing weak consumer demand. Then we're also looking at sterling. That falls ever so slightly for a second day. We had those inflation figures yesterday that caused that pump up in front end yields, about 30 basis points at one point, and a weaker pound. So in terms of the overall European picture, again, it's mostly lower. It's mostly lower this morning. There are concerns about a debt agreement. We had that Fitch warning. That was enough to turn sentiment. And then we also had some Fed speak trying to price out cuts in this market. At least that's what Waller was talking about, saying a skip. Again, not great for risk sentiment. So most of these regions are lower. Again, if you were to just pull out the mega caps, pull out the big tech ones, especially with an AI exposure, they would be doing well. On that note, I do want to show you what Nvidia shares have done in the pre-market trade. We should just be getting a reading on that. 23%. Again, after the close yesterday was up about 25%, so we're easily holding on to that. You know, I did look at the Nvidia sales call yesterday. 122 times is how often they mentioned the word AI. Everything that's a chip maker, everything that touches AI doing well today, whether it be the Asia trade or the Europe trade. Let's get more into that Nvidia story and get over to Bloomberg's Alex Webb. Alex, why is Nvidia the winner of AI here?
It is a bit of a cliche, but they are very much the makers of the picks or the shovels for the gold rush. We've seen a huge charge into AI, and the companies leading that charge, particularly Google and Microsoft with its relationship with ChatGPT maker OpenAI, they're very much pitching these as cloud products. If you want to be using their large language models, you probably need to be using Azure in Microsoft's case, or Google Cloud in the case of Google. If it's going to be a cloud product, that means you need to put the processing power in the cloud. And of course, Nvidia makes the chips that can do just that. That's why we're seeing this huge surge in demand. The forecast that they made for the current quarter, the quarter we're in, was 53% above analyst expectations. A sort of mind-blowing beat. And that's why we're seeing such a huge pop in the stock.
A mind-blowing beat, but still it's up over 100% year to date. Its price has doubled. It is richly priced. There's, of course, a lot of hope here, but a lot of this pricing is hope. What will it take for Nvidia to continue to live up to those expectations?
I think the question is actually whether they can meet the demand. The demand for AI chips is going to increase not just from the cloud operators, but increasingly we're going to see this come closer to the edge. Of course, when I talk about the edge, that's perhaps on cell phone towers. It's in company server farms. They need, if they want to have AI that reacts very, very quickly to requests, you don't necessarily want to be handing it off to a server that could be miles or hundreds or even thousands of miles away. So that actually is the long tail of demand that could well be there at the moment. Yes, we are very much in the peak of the hype cycle, but unlike something like Web3, this is technology people can really get their teeth into. They can see real world applications. They can also see how it can reduce some of their costs. So I think that's one of the reasons we're seeing the stock price so generously, because there is a huge amount of optimism about this very real technology.
Yeah, and that's perhaps a strong distinguishing factor to make between that and what was someone called the crypto bubble of years past. Hey, Alex, thank you so much for the update there. That's Bloomberg's Alex Webb. Now, if that's the thing that has markets excited, let's talk about the thing that has markets pessimistic this morning. Ratings agency Fitch has put the U.S. AAA rating on negative watch as tensions over debt talks continue. House Speaker Kevin McCarthy did signal some optimism that a deal can be done in time to avert a default after top negotiators met on Wednesday. Let's get to Bloomberg's Bruce Einhorn on this. So, Bruce, Fitch issuing a warning here. Where are the current talks standing at the moment?
Well, there's no deal yet, which I think isn't a surprise to anybody. Nobody was expecting that there'd be a deal that this soon. Expectation is we are going to get closer and closer to the deadline. When that deadline is, Janet Yellen says that it's as early as June 1st. That's the X date. Many Republicans have expressed doubt about that, saying, oh, no, we have more time. Negotiations are ongoing. As you said, there was a multi-hour meeting at the White House between the two sides. Interestingly, this came a day after one of Speaker McCarthy's deputies, Representative Patrick McHenry, had said, oh, we have the upper hand because the negotiations have been going on at the Capitol. And then they did it at the White House. As far as what are the key differences, where the key areas of disagreement, we know that the two sides still don't agree on what sort of restrictions there should be on spending, how long those restrictions should last. The leader of the Democrats in the House, Hakeem Jeffries, said that any cap on spending could only last as long as the actual increase in the debt ceiling. That's different than what the Republican proposal that passed through the House recently was said, which was that they wanted to have a 10-year spending freeze or restriction on spending that would go for 10 years, while they would extend the debt ceiling only by about a year. So Jeffries of the Democrats has said that's a non-starter. Other disagreements have to do with things like work requirements for recipients of Medicaid. So still a lot of issues where the two sides still remain far apart. As far as the calendar goes, we're looking at a long Memorial Day weekend coming up, and so the House won't be in session. However, Republican leaders have said that they've told members they need to be prepared to return on short notice in case they have to vote on a deal. Danny.
Okay, Bruce, thank you very much. That's Bloomberg's Bruce Einhorn there. All right, let's get to some of our other top stories with the Bloomberg First Word News is Alex Morgan. Alex.
Danny, good morning. Well, we start in Germany, where Europe's biggest economy has suffered its first recession since the start of the pandemic. Germany's first quarter output shrank 0.3% from the previous 3 months. That followed a 0.5% drop between October and December. Well, the government's stats office said lower household spending on food, clothing, footwear and furnishings was responsible for that weak data. Ron DeSantis has officially launched his long-awaited US presidential campaign, signaling he's going to make culture war issues central to a strategy to win the Republican nomination. The Florida governor made the announcement on a Twitter live stream with Elon Musk, which was beset with technical glitches and with audio problems. Well, polls suggest DeSantis is currently the strongest challenger to the frontrunner and the former president, Donald Trump. Bloomberg has learned that US prosecutors are reviewing stock trading by some First Republic Bank employees during the lender's collapse. The Justice Department is looking at whether anybody working at the bank used inside information as the firm crumbled in what became the second biggest bank failure in American history. Well, that is global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Alex Morgan, and this is Bloomberg. Danny.
Alex, thanks so much. Now, coming up, private credit is booming as lending conditions tighten from banks in the wake of the recent banking turmoil. We're going to discuss opportunities in the market and plenty more with Jim Zelter, Co-President of Apollo Asset Management. That's next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Let's discuss the burgeoning market in private credit. According to a Carlyle Group report, funds at firms like Apollo and Blackstone have financed as much as 94% of buyouts in the first quarter via private credit. That's happening as traditional debt investors turned cautious, spooked by rate rises and banking turmoil. So let's talk about it. Joining us is Jim Zelter, co-president of Apollo Asset Management. Since joining Apollo in 2006, he's led the expansion of the firm's credit platform, which now oversees $350 billion in assets under management. Jim, thanks so much for joining this morning.
Good morning.
You're here in Europe. We shouldn't say you haven't just gotten bigger in general. You've gotten bigger in Europe. You've got a new office in Soho. First time there?
Yes, we had a couple of offices over the last. We've been in Europe for almost 20 years.
Yeah.
We had 2 offices in London. We've got a few on the continent, but you know, a lot of great growth the last 2 or 3 years as our business expands around the continent, around the UK. So we found ourselves needing space in London and have a great new office in Soho, which we're excited about. We opened it about a month ago.
Yeah, you're really in the heart of London. I got to say, it almost feels like such a statement at a time where, you know, inflation is really high in London. There's concerns about the economy. To really double down on this area, not just the UK and Europe. How has your investing philosophy changed in Europe? Is there anything you're looking at now that you weren't before?
Well, I do think, you know, since we've been around Europe the last couple decades, there's been obviously a variety of economic cycles, but also the evolution of the banking business. You know, what the big banks in the UK today versus 10, 15 years ago is obviously dramatically different, very similar to the US. And so the role that we play as an integrated platform, investment grade, leverage finance, asset-based, along with our private equity and our real assets business, we're just playing a larger role in the financing market. So it's not a surprise that we've basically doubled our staff in London the last 3 or 4 years, and also on the continent. We expect that trend to continue.
I got to say, it's also a good time because the pound has weakened significantly. So hopefully you got some dollars to spend while you're here.
We did all right. We've done all right. No complaints.
Fair enough. So, but on that point, I mean, inflation has been really persistent in this country. Are you worried about the economic outlook for the UK and for Europe, for that matter?
Well, certainly you have to be cognizant of the backdrop of inflation and the other economic cycle issues. But, you know, great, robust G7 economy, rule of law, great consumer presence. So we're committed to the UK. We're committed to the G7 Western European economies. A lot for us to do across our platform. So while there's cycles here and there, you have to be cognizant. The big long-term secular trend is a big opportunity for us.
Well, speaking of European opportunities, in what feels like years ago, but I'm confident it was only in November, you bought the securitized products business out of Credit Suisse. How's that integration gone?
We've been very, very fortunate. You know, there's been a big spotlight because of the challenges in the deposit crisis in the U.S. and the banking system. A lot of services, a lot of products that had historically really been the domain of banks really are in the heart of the securitized products business that we bought from CS. We've renamed it Atlas. We've done all the closings. The balance sheets come over to our firm. So we couldn't be more excited. A lot of great momentum and the role that they are playing in the U.S., but also in other burgeoning economies like Europe and Australia. We think that's going to be a big part. So couldn't be happier with the purchase. Integration is on pace, and a lot of capital formation, but also, you know, a lot of client products are being created out of that.
Well, Credit Suisse is also a very different beast, maybe not a beast at all anymore since you did that. Anything else you'd want to buy from them?
No, I think, listen, UBS has their hands full right now. They have great leadership. They'll figure out the right way to take that business. I mean, I think the bigger picture is, you know, the transition from this whole banking challenge in the U.S. right now, the banking crisis, is just a lot more partnership going on. There's a narrative that the banks win, private credit loses, and vice versa. The actual reality of that is there's much more partnership going on than ever before. Whether it's on these club deals that I'm sure we'll talk about or other parts of the finance market, great partnership with the big banks in Europe, in the UK, as well as in the U.S.
Well, Credit Suisse was known as this big presence in terms of the leverage market, the leverage loan market. How much of a difference has that made in Europe to not have that anymore?
You know, certainly if you look at the league tables, there's other firms that have made, you know, great presence in the marketplace. I've seen Barclays, BNP, many of the other regional institutions pick up the pace. So these are competitive marketplaces. When somebody does stumble, there's usually someone else to come on in, quite quickly, actually, and fill in. But the bigger picture in Europe is not only what's going on amongst the banks, but as you mentioned, the role of private credit. Private credit is playing a larger role in financing. It's going to continue to, and not only in the non-investment grade, the leveraged finance side, but also in the investment grade area as well as asset-based finance.
Right.
That's where the future of the business is going.
Okay, well, we definitely have more to talk about. We're going to take a quick break. We'll get back to all of that. We'll dive more in.
Great.
Deeper in. Jim Zelter there, co-president of Apollo Asset Management, stays with us. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Still with us is Jim Zelter, co-president of Apollo Asset Management. Jim, so I'm heading off to Berlin for Super Return a bit. I'll see your colleague Scott Kleinman there. And it is a moment, we're talking about this in the break, where private equity still has a lot of dry powder. But there's a lot of hesitation when it comes to doing deals. So where do you, the private capital side of the business, fit into that environment?
Well, I think the comment right now is there's certainly a cloudy future. Worries about inflation, worries about economic slowdown in different parts of the globe, obviously the debt ceiling more particularly. But the reality is the financing markets are open. They're just not as buoyant as they were 12, 18 months ago. So as a private equity investor right now, you're confronted with a marketplace where while there's clouds on the horizon, the prices of assets have really not moved down. And so there's a bid offer between purchase price and seller price. That's why M&A volumes are a bit down overall. But the reality is private credit now really is a very broad scale, legitimate answer or tool for many, many private equity firms when they're purchasing a company. Private capital gives certainty, it gives scale. They're able to go to the market quite quickly.
Right.
And that ability is a big part of the market. So if you are a private equity sponsor and you have a company that you want to buy, you can get financing right now. The terms are a little bit higher. Many folks have, in terms of my partners, have been out there saying golden era for credit. For 10 years, you were not getting paid much to be a lender. Now you're getting paid north of 10%, depending on the type of company on leveraged finance.
Just to that point quickly, because
Yeah.
I mean, that is an attractive yield to get right now. If you have private equity valuations maybe starting to come down, credit is looking more attractive. Well, does that mean that all of a sudden it's much more easier to fundraise when it comes to the credit side of the business?
There's no doubt around the globe right now, investors virtually in every region, private credit had been an asset class that, 10, 15 years ago, it was high yield or distressed. It was very binary. Now most investors have a credit allocation, 3 to 5%. It's going up to 10 to 15%, depending on the investor around the globe. So raising capital for private credit, and it's one where scale does matter. The largest firms are getting the lion's share of it. But yes, it's a quite interesting time. As you mentioned, on a relative risk-reward basis, getting those type of returns for being senior in the capital structure, quite attractive.
Absolutely.
Yes.
It's good for investors, but what about companies who are already facing higher costs? Can they handle 12%, say?
Certainly a bit more challenge, and some that have pricing power and have higher margins, certainly yes. Certainly those who did not really fix their floating rate risk and do so in a prudent manner, those higher interest costs will cause some challenges. So, if you look out the next 12 to 24 months, one has to believe if historic defaults are in the low 2s, 2.5% to 3%, those numbers may be challenged by companies that are having higher interest costs across the board.
Well, what do you expect for this default cycle?
What we see in the U.S. in particular is really much more of a regional recession. Industry and regionally. Some places, whether it's Florida or California, Florida or Texas, are doing quite well. Other parts of the Midwest, of the Northeast, may be some challenges. There are some industries that are consumer, whether it's hotel, lodging, entertainment, that are doing very, very well. Some of the companies that are more industrial-based or auto-based are having a much more challenging time. So I don't think it'll be a recession that will be a broad brush across the marketplace and across the globe. I think it'll be regional and industry specific depending on the country or the continent.
What is the type of downturn that you do start to get worried about credit markets?
Well, I think if you had a much, we are in uncertain times with what would happen in quantitative easing for a decade plus. The rates have risen dramatically over a short period of time. And, I think the market is sort of waiting for that impact, and financial conditions have certainly tightened in the U.S. And other parts of Western Europe, but we really have not seen the immediate impact. And it's like bankruptcy. It happens very slowly and then very suddenly. So I think for those of us who've been around for a number of cycles and are a bit more patient, I think when you raise rates as high as we have and as quickly as we have over the last 12 to 15 months, we were really seeing it in 23. 22, you had the impact of higher rates, but it really wasn't felt in the market. 23, you're feeling it more so in the marketplace.
Well, I hate to end on that pessimistic note, but Jim, we're out of time.
Great.
But hey, we're not too far from Soho here. I have a free schedule if you want to show me the new digs.
Come on over. We have a great place, great coffee bar, and our employees love it.
I'll never turn down a free coffee. Hey, Jim,
Great.
thank you so much for
Thank
stopping
you.
by. Jim Zelter there, co-president of Apollo Asset Management. This is Bloomberg. Good morning and welcome to Bloomberg UK. I'm Danny Berger in London. On today's show, we focus on the British real estate market as households react to the fastest interest rate hiking cycle in decades. Latest official data from the ONS and Centre for Cities show that London employees are now appearing in the office less than half of the week, with older workers leading the shift to remote working. And that's taking a toll on city centre retailers, transport operators, and of course, property values. British real estate company Savills recently said that transaction volumes for offices and malls are down by as much as 80% in the past 2 quarters. The report says that capital values in the City of London are down by 21%. Of course, our Bloomberg intelligence team says European real estate investment trust property values in Europe may drop further as interest rates continue to rise. They say the reality of higher property yields has yet to hit as rent inflation buffers the initial expansion. Of course, complicating this matter too is ever higher inflation, or at least not subsiding inflation. We had that data this week, and it had a reaction in borrowing costs and in the gilt market. So let's get into all of this. Let's get more on the commercial property sector. I'm joined now by Sue Munden, senior industry analyst for real estate at Bloomberg Intelligence. Also with us is Bloomberg senior reporter Jack Sitters, who covers European real estate. Sue, if I can start with you just to get the macro outlook. So how has rising interest rates impacted commercial real estate values?
Well, it's quite profound, obviously, as you've been saying. The increase in interest rates has pushed up yields. Generally, we see those tracking each other when we price property off a 5-year swap. So in the UK, for example, the 5-year swap has gone, as we know, from 1 to 4.5%. What we've seen in the commercial property market is that the sort of valuation consultants have moved yields out quite considerably. But when we look at what's actually happening to the REITs and to property companies, there's so much uncertainty because we haven't actually seen much transactional evidence in the market that they're tending to do it more on a case-by-case basis. And so as a result of that, the move up in rents that we've seen in some of the areas is proving some of the buffer. That said, we've seen falls of at least 10%, 15% or so since September in London offices. Paris offices have hardly moved at all. We've only seen a 30 basis point, maybe 50 basis point yield expansion there out of that sort of 270 that we should have seen.
Right.
So yeah, I think there's still more to come as this resets. But until we get that inflation number more secure, and we know that we're sort of getting on top of it. I think it's the transactional evidence is still going to continue to be quite slow.
Right, and of course the inflation side of things, Jack, is very much so linked with the fundamentals. Just in terms of underlying demand, what have we seen for some of these cyclical spaces?
Yeah, sure. It's really interesting, actually, this cycle, because normally you associate a real estate correction with a kind of downturn in the fundamentals, in the operating environment. But actually this time, that's not really what we're seeing. You probably need to look at it by asset class. And I guess if we start with offices, because that's probably the big investor concern at the moment, again, really important to draw the distinction between Europe and the US. The US, we know, really high vacancy, a lot of alarm about regional bank exposure, etc. Yes, London occupancy in terms of the return to office is not quite where it was pre-COVID, but actually on the leasing side and on the rental side, for the best space, there's a real shortage of it. And that's partly to do with increasing environmental regulation and also environmental targets for occupiers. They want to be in the best buildings, they want to be in the greenest buildings, they want buildings that are going to bring their staff back. And there hasn't been much of that stuff built over the last few years. You know, we've had Brexit, we had the pandemic, developers haven't exactly been full of confidence. So there's a bit of a shortage there, and that's actually keeping rents high and getting higher. On the industrial side, warehouses, that demand is still very strong, maybe slightly less booming than it was during COVID when everyone was buying everything online. But again, leasing still looks pretty healthy, rents still moving up. And then retail, I mean, it had a brutal few years. But there are signs that it's pretty much bottoming out. You know, there are still, I think, central London retail probably still quite soft. But in the shopping centres, arguably in some ways, the pandemic kind of cleaned up those tenancy schedules. There was a lot of retailers in there who, you know, maybe should have stopped doing business a while ago, and COVID finally did for them. Right,
yeah, I mean, let's be honest, those retail centres were empty during COVID, so fair enough that would have happened. But beyond just sort of the footfall, Sue, and the hesitancy, as Jack was talking about, for building new offices, what has just higher costs of capital, higher debt costs meant for developments?
Well, there again, we're going to see that slowing down. What we're seeing at the moment is quite a lot of renovation because that's a short cycle thing and there is some capital there. So with big companies, large developers, where they'd already got the funding in place on a low cost, they're going to continue with those developments. But putting something else into the market, going on site, is going to change, I think. And we haven't seen that much. So either what they'll do is they'll try and get a pre-let, a big pre-let, so that then underwrites their costs for them and then try and work the package out together, see if it works. Some are expecting to get lower IRRs, so where you've seen, you know, double-digit IRRs, they may be coming back to high teens and still want to go with it. But the other side of it as well is when are you going to deliver the space? So REITs like Landsec and Great Portland yesterday were saying that they are going to be delivering into 26, 27, at which point they think there's going to be very limited supply, and because, you know, people haven't been able to start on anything in the next couple of years, and so that means that they're hoping that the rents will have gone up because the supply will be tight and the whole thing will work. But yeah, it is very much a moving target at the moment.
Right, and Sue, you mentioned this. I just want to dig into this idea a little bit more. UK versus the rest of Europe. Again, Jack, Sue mentioned specifically Paris. Let's get into that. Break it down. How does UK compare to the rest of the world right now? Sure,
yeah. I mean, actually, the UK, as it often is, seems to have corrected much more quickly than the rest of Europe. And listening to a lot of the executives, you know, we've just come through earnings season, all the REITs have had their earnings calls, and the message from a lot of the executives is, you know, we think the correction may be nearly done in the UK. You know, prices are starting to find a floor. Big caveat: transaction volume still really thin, so very hard to judge. But yeah, the UK has moved. The valuers have moved their yields out. In Europe, that just really hasn't happened to anything like the same degree. And actually, if you look at stock market prices, so the price of the publicly traded landlords, you know, clearly that has corrected. And if you take that at face value, then the market is pricing in really, really severe correction in private asset values. So I think we've got a long way to go yet in places like Germany, like Paris, whereas in the UK, potentially there are signs we might be finding a floor.
Can we use those public valuations for a guide for private, or is there a sense of panic perhaps in those and it's somewhere in between?
I think it might be somewhere in between. I guess that's the easy answer, isn't it? But nevertheless, in the private markets, the debt piece has probably not quite started to hit yet. But as those refinances come up, and typically you've got a 5 or 10 year debt behind something, as they start coming up, and then you have to go to the banking sector, and obviously, you know, they're holding back on their loans into the sector at the moment, or anecdotal evidence would suggest that. You know, those prices are going to go up, and it's going to then sort of move out in the private sector as well. In the listed sector, it's also a question of the operational side, which, although it's quite buoyant, most of the REITs are saying that their earnings are going to be flattish this year. So if you haven't got that much excitement there and not much dividend, then to get even to par would be a very good day.
Right.
So I think that we may still have a considerable discount to NTA until we really get through the other side.
I've got a solution for them. They simply need to say they're an AI company. I think in the market, that's their solution right now.
Some of them are working on it, but
there you go. There you go. That's a whole other show, Sue. We'll have to bring you on for that. Hey, Sue, Jack, thank you so much for joining today. That's Sue Munden, Senior Industry Analyst for Real Estate at Bloomberg Intelligence, and Bloomberg Senior Reporter Jack Sitters. Coming up, out of office, more on what London's shift to hybrid working and continued shift means for the future of the city. We're going to be speaking to a commercial property expert next. This is Bloomberg.
Since the pandemic, the ways that people are working have changed significantly, with more people working from home, perhaps not all the time, but 2 or 3 days a week. And as a result, there is less demand for some office space. But we haven't seen the sorts of problems in the UK market that we've got in the US. But of course, we've got to be vigilant and always be aware of risks that could put financial stability under any sort of strain.
Rachel Reeves there, the UK's Shadow Chancellor, speaking to us earlier this week on declining office space demand as more people work from home. Now let's get more on that trend. Research suggests that London workers are spending, on average, less than half of the week in the office. So what does the change to hybrid working mean for the future of the city? Joining me now is Phillip, the head of London offices at Knight Frank, which of course has much office property around London. Phillip, great to speak with you this morning. I got to say, I was really surprised by the stat, maybe because I'm going into the office every day. But what has that done in terms of impact to values for office buildings?
Well, it was interesting. Morning. Thank you for having me. Interesting to listen to Rachel's views earlier in the week. I think that our view is slightly more nuanced than that. What we are seeing is a real divergence in the market between prime new space and secondary space. Now, we're seeing actually rental growth still coming through in prime space. And that's because it's basically addressing the needs of occupiers in the post-pandemic world. If you think of the dynamics around returning to the office, trying to get your talent and your teams back into the office, where they've sort of proved that they can work quite successfully from home. Occupiers are basically trying to deliver much more amenity-rich, much more dynamic environments that are going to support the workforce back in the office. We're seeing the increase coming through sort of month on month in terms of return to work as the mood music really changes from the occupiers. From the management have been understandably soft touch on it over the past 2 years post-pandemic, because it's such a significant impact on us all. But I think that with that mood music changing, impact starting to come through in lack of productivity, it's time for people to get back to the office.
There's demand for the best offices. There's demand for new, sparkly, shiny buildings that have good energy ratings, have things like that. But we are in this environment where the cost of capital, the cost of debt is higher, interest rates are higher, perhaps putting a dampening effect on developments. How big of a mismatch is there between the demand and actual properties which fit that bill?
Well, you're absolutely right. The cost of development in terms of materials, cost of finance for development, and also the planning regime has become really hard. It's a real barrier to entry. Now, it's that sort of fundamental structural lack of supply coming through over the next 5 years that's underpinning the market and our view of its performance over that 5-year period. But based on our market data, there's probably a structural undersupply of about 9 million square feet in the London market between now and 2027. And that undersupply will be based on just long-term average levels of take-up of that best prime new space. So not an absolute bull market, but just working on the basis of the long-term average rate of take-up. So that is going to continue to provide some rental pressure for developers who do commit to construction on the future prospects for rental growth from that speculative commitment.
Hey, Phillip, what does stickier inflation in a low growth cycle mean for you overall? At the moment, money markets just today fully pricing in 100 basis points of BOE rate hikes by December. Should we see another tick up in the rate hiking cycle, what sort of impact would that have on you?
It's going to just slow down the market. I mean, it's been massively impacted, the investment market, since the mini budget at the end of last year. The cost of money, cost of debt has just really made the appeal for the investor ebb significantly. They're waiting for that repricing to come in. There's no sort of pricing discovery. You know, what is the value of offices now versus what it will be in another 6 months' time. So it's definitely delayed the money coming back into the market. There's definitely the appeal there. We're seeing significant capital from both private investors, but also active capital, particularly from Asia Pac, really keen to get into the London market, but they're just waiting for that pricing discovery to come through and the rates to come down.
Hey, Phillip, where can you get the highest rents right now? What area of London is the most in demand?
Well, actually, we've seen quite significant activity in Mayfair and St James's, what we call the core West End market. It's the home of the boutique financials, private equity, venture capital, and hedge funds. We're anticipating the £200 a square foot barrier to be broken this cycle. We've come very close to it. There have been some very significant deals, such as Blackstone committing to over 250,000 square feet on a block, the entire south side of Berkeley Square. So the demand from that sector, who tend to be sort of counter-cyclical, they like a volatile market, they've been very successful and have a lot of money under management. So they've been committing to new office space that supports their high-value talent. And so we're expecting the £200 per square foot barrier to be broken sometime soon this cycle.
And we just had the co-president of Apollo on, who, of course, just opened up a brand new office in Soho. Of course, not the area you're talking about, but still more in that sector. If that's the sector that's putting more money into the office space, who are you seeing pulling away?
Well, the tech titans have been noticeably absent. They've been right-sizing their portfolios in London, obviously in response to their reduction in headcount. So they're significantly missing from this cycle. What we are seeing, though, is activity from the other elements of tech, so fintech, medtech. They're all actually quite active, but much smaller scale and not necessarily active in the core markets.
Okay, Phillip, thank you so much for joining us today. That's Phillip Hobley, the head of London offices at Knight Frank. And be sure to subscribe to Bloomberg's In the City podcast on Apple Podcasts, Spotify, or wherever you get your podcasts. New episodes drop every Thursday. Coming up, safe as houses or trouble ahead? We'll be exploring the outlook for UK's residential property market. This is Bloomberg. Economics, finance, politics. This is Bloomberg UK. I'm Danny Berger in London. Now, we've been talking about commercial property, but is the residential market defying predictions of a slump? Online property site Rightmove said average asking prices jumped 1.8% in May, hitting a new record high. And official data shows house prices rose more than 4% year on year in March. But shares in UK house builders fell yesterday as Britain's inflation rate came in stronger than expected, fueling bets on more interest rate increases. Let's get more now on the state of play in the UK housing market with someone who loves to talk about it. It's Bloomberg's John Stepik. John, the latest data does show that there's some sense of bouncing back. What do you make of it?
I mean, I think the latest data is very interesting, and I think it reflects the fact that basically mortgage rates spiked in September and October, and that basically pulled the rug out from under the market. You had a lot of transactions that would have gone through maybe in the fourth quarter of last year, and those, I would say, have been bumped forward to the first quarter of this year. And what's happened is that mortgage rates have actually gradually stabilised and come down since October. So you can see why the activity would have picked up. It's almost kind of, I hesitate to say a dead cat bounce, but that kind of movement. And the problem now is that after yesterday's inflation data, the market is now predicting interest rates going to keep going up.
Yeah, 100 basis points is what we fully priced in terms of rate hikes by December. What does that do if we get to that point?
I mean, that was really brutal. I mean, I was actually quite surprised by the market reaction in some ways, and it shows you just how much worse the inflation figure was than was expected. And really, the problem is that mortgage rates are priced off future interest rate expectations. So this will immediately have an impact in terms of how banks are thinking about, well, what kind of new business are we going to write? Now, lots of things obviously do affect the mortgage market, the amount of competition between banks and how much demand there is out there. But the higher rates go, the less that people can borrow to pay for, houses, basically. So I do think that this kind of move back up is it's, as I say, it's kind of a rebound rather than anything that's going to be sustainable. That doesn't mean that, you shouldn't go out and buy a house if you are planning to buy one anyway. But I do think that it's important to understand that, the recent easing down in mortgage rates that we've seen has probably now ended, at least for the time being, and quite possibly they will go up in the future. Because that, as you say, is like a sharp bounce in interest rates.
Yeah, I mean, I was just talking to a friend who's looking at buying a flat and looking at a 2-year mortgage, and I wanted to confidently say, yeah, in 2 years, you'll be okay. You can refinance and things will look better. I don't know, in 2 years, there's been some really sticky inflation. I mean, I hope we're still not around 5% in 2 years, but...
You would hope, but I mean, the thing is, the post-2008 environment was really unusual. So we had the lowest interest rates in 5,000 years, and I'm not making that up. There's an actual study that shows that since Babylonian times, interest rates had not been that low in the UK or in the US. So if we're going back to something approaching a more normal time, I mean, I remember I got my first mortgage in the kind of early 2000s, and the rate was 7%, and that wasn't unusual.
Right.
The difference is that obviously house prices were lower because you couldn't afford to borrow as much to buy a house, and that's the kind of fundamental problem at the moment. We've got house prices are at record levels, affordability is the worst it's ever been, and now the cost of borrowing is going up. So there's really, it's very difficult to see how you avoid a situation where house prices go down, because there simply isn't the volume of money going into the market anymore, which is what drove it up in the first place. As to what happens in 2 years' time with interest rates, my point is don't gamble your future on it. If you can't afford for rates to go up any further than that, then maybe trying to fix for a longer period of time wouldn't be a bad idea.
Well, I got a flat to sell you in South Kent if you're still willing to buy and not gamble. So, hey, John, thank you so much for joining. Really appreciate it. As always, that's Bloomberg Wealth's John Stepek. Now, Bloomberg Surveillance Early Edition will continue in the next hour. Kriti Gupta is in New York. Anna Edwards is in London. A whole lot more to discuss, not just the UK, but we've also got debt ceiling fears and AI. This is Bloomberg.
This is Bloomberg Surveillance Early Edition with Anna Edwards and Kriti Gupta.
It is 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Nvidia surges, the world's most valuable chip maker hikes its sales outlook on strong demand for AI processors. The results are fueling a rally for its rivals and giving Nasdaq futures a boost. Downgrade warning. Fitch puts America's AAA rating on negative watch as House Speaker Kevin McCarthy expresses optimism that a debt deal can be reached on time. And Ron DeSantis officially jumps into the race for US president. He held a Twitter Spaces event with Elon Musk last night that was plagued by technical glitches. Welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie, stepping in for Anna Edwards in London, with Kriti Gupta, of course, in New York. Kriti, the optimism around AI so far lifting the markets, looking past the debt ceiling doubts and gloom.
Yeah, I mean, look, we've seen a market here that has been kind of on the sidelines, at least when you look at the equity market, the bond market really catching the action. But Nvidia just changed the game when it came to their earnings. Look, the second quarter forecast, 1.5 times the Wall Street estimate, really fueling not just Nvidia shares, but to your point, the entire complex. Take a look at NASDAQ futures here, soaring in pre-market trading, higher by 1.7%. Relative to the S&P 500 futures, that's only up about 0.5%. So again, almost 3 times the gain, more than 3 times the gain you are seeing in technology this morning. That's just a taste of what we might get after the opening bells. The 10-year yield also crucial. Like I said, the bond volatility really going to be in focus, Tom, as we talk about not just the debt ceiling debate, but how the Treasury starts to navigate it. We've got auctions coming up today that may or may not get delayed in fear of not just this downgrade warning that you now have from Fitch, but the idea here simply that maybe, just maybe, now is not the time to take on more debt after talking about that default. So we are, of course, on auction delay watch. The 10-year yield sitting at 374, unchanged at the moment, but really keep an eye on this as we get those announcements coming out of Washington. The Bloomberg Dollar Index kind of taking its cue from the bond market here, only higher by 0.1%. It's nothing I would write home about, but something I got to say, our colleague Eddie Vanderwalt over on the MLive team early on told me, Tom, was that when gold and the dollar are both moving in the same direction, that inverse correlation is not kicking in. It tells you the market is in acute stress. And I think you're starting to get a little bit of a taste of that today as gold resumes some of its gains this morning, higher by about 0.3%, Tom.
Yeah, let's see if that yellow metal crosses that 2,000 level and what that tells us about the risks then emanating from DC. Here in Europe, yes, there has been a bit of a lift in terms of the push and pull versus AI coming through in terms of driving higher, particularly the likes of ASML versus those concerns, of course, about a potential downgrade for the US from its AAA rating. On the AI front, it is ASML. It is the standout. It really is the only company that produces those very high-tech machines that end up being sent to the likes of TSMC that produce and churn out chips for Nvidia and many others, of course. So you're getting a lift for a lot of the Dutch equipment makers around the semiconductor space. Across the benchmark here in Europe, you're now seeing gains. It's been a bit of a choppy session so far in the session this Thursday, but you're seeing gains of close to 0.2%. The pressure and the pain being felt yesterday in the real estate sector, that has started to come off a little bit, at least for that area of the market. The DAX now down about 0.1%, losing 23 points, and the German data coming out for the first quarter confirming that, in fact, Europe's largest economy did fall into recession in the first 3 months of this year. Euro dollar 107, down 0.2%, largely as a result of the strength coming through for the US dollar. But what does it mean, the weaker print out of Germany for the ECB? Do the hawks, are they still in the ascendancy? That debate remains live. JP Morgan Asset Management telling us earlier they still think 2 further hikes coming through from the ECB. ASML, there's the move then higher on the back of the linkages to Nvidia and the optimism around AI, up 5%. Kriti.
Well, sticking with that optimism, the AI story, the frenzy swelled demand at the world's most valuable chip maker. Nvidia's sales forecast for this quarter smashing expectations. Nvidia shares edging higher, not just in the pre-market, but in the post-market yesterday as well, with rivals like AMD jumping as well, really getting along for the ride. Joining us for more context here, Bloomberg's Alex Webb. Alex, Nvidia isn't your traditional AI play until now. Walk us through it.
It's a bit of a cliche, really, but they are making the picks or the shovels for the gold rush. The chip making, they are, that was the first sort of half of their 3/4 of their history was very much to do with GPUs, processors for gaming. What they've managed to do is adapt that technology, and in the latest generation, they are really making the bleeding edge chips to drive AI functionality. And of course, the companies that are driving the AI adoption are Google and Microsoft through its relationship with ChatGPT maker OpenAI, and they're pushing them as cloud products. So if they're cloud products, they need to be putting the AI functionality into their cloud servers. They therefore turn to Nvidia and buy up as many of these chips as they possibly can. So we've seen a 53%. So the forecast for this quarter is 53% above what analysts had expected, and that's why we're seeing such a massive bump in the share price.
Wow, it's just huge, isn't it, in terms of the analyst expectations versus what they're forecasting now. Is this, though, a case of a one-off boost for Nvidia? Is this building out their customers of these data centers with these AI chips, or is there some sustainability for this business?
I think the expectation is there's quite a lot of sustainability. If you look at where the stock is trading, it's at something like 53 times its forward earnings, 50 odd times its forward earnings. Presumably that'll come down a bit as the earnings increase, of course. The long tail, really, we're looking right now at the bleeding edge at the servers. There's going to be a long tail of people wanting more AI functionality, particularly as it gets closer to the edge. If you're saying, I want AI functions in whatever my services might be, but I want them to be hyper responsive. At the moment, there's a bit of a lag. It goes off, talks to a server miles, tens of miles, hundreds of miles away. As that functionality gets closer to the edge, it gets put in cell phone towers, perhaps even in company.
By the edge, you mean closer to the end user? Exactly,
close to the end user. The extreme edge is here on my mobile phone. There is some AI functionality in Apple's chips and these things, but that might be the ultimate place it goes. Now look, the Nvidia chips, they cost $10,000 a pop. Unlikely to see them in mobile phones, and anytime soon, that is. But certainly we'll be seeing them closer and closer, further and further away from the main cloud servers and in companies in cell phone towers.
OK, Alex Webb, excellent. Thank you very much. On the corporate story of the day, of course, around Nvidia's results and that smashing outlook in terms of demand for AI chips. Now, Fitch has warned it may downgrade America's AAA credit rating because of the political impasse surrounding debt limit negotiations. Former Dallas Fed President Robert Kaplan spoke exclusively to Bloomberg's Kathleen Hayes on the possible implications.
I think what's going on with Fitch speaks to the fact that default should be off the table, but we do need a real discussion because we're going to have problems down the road if we don't get fiscal discipline.
All right, joining us now is Bloomberg Economy and Government Editor Jill Deisis. Jill, get us up to speed on where the debate is in Washington around this debt ceiling as the clock very much ticks down.
Definitely, Tom. So look, at this point, we've had negotiators from both sides meeting for 4 hours yesterday to try to work through everything. We've really only got about a week left before this comes together. And as of right now, Kevin McCarthy, the House Speaker, may see that things seem very optimistic. But I think as you saw from that Fitch putting their credit rating on watch, I don't really know that that's pouring over into what markets and analysts are seeing right now, because what they want to see is a deal done. And so far, it still seems like there's still a lot of daylight between these two sides. Are they going to resolve what the Democrats want, which is cuts to defense spending? Republicans don't want that. They want to target social services spending. It seems like we're still at odds here with what's happening here. So unless these two sides come out of one of these, multi-hour meetings and actually say, yes, we have a deal, then that's what's going to actually move us forward. Because remember, it's not just about Biden and McCarthy agreeing and their negotiators agreeing. It's also about getting something through Congress, through the Senate, like it actually passed. And we're counting down to X Day pretty quickly here. So they've got to make something happen soon.
Jill, I want to quickly, for the sake of our audience, really quickly talk about what the wording actually was from that potential downgrade. The rating watched negative, reflecting increased political partisanship that's hindering reaching a resolution to raise or suspend the debt limit despite the fast approaching X date. Increased political partisanship. Jill, this is exactly what you're talking about here. From Kevin McCarthy's comments yesterday, though, of all the different sticking points, it feels like there's only that one left, though, the spending story. The defense seems to be out of the way. The work requirements for the aid seems to be out of the way. Even the timeline, not as much as a sticking point. Shouldn't that be interpreted as some pretty significant progress?
Sure, yeah, I think that that's definitely part of the progress. But again, until they actually resolve some of those spending concerns, then that's really what the market wants to see, right? So we actually need to come out of this with a deal. So it's somewhat encouraging for McCarthy to say, we, have reasons for optimism. Hopefully we're working toward a deal. But until that, until the ink is dry on some kind of agreement that they can actually present, it's not really going to matter. And also, again, because this has to pass through Congress, McCarthy also has to get Republicans on board with, something that's happening here, because I think he's made pretty clear that he doesn't want to do anything like, put this off for a little bit, try to, delay things until they can come to an agreement later. So it's not just about what they can hash out between these negotiators, but it's also about what's going to happen with Congress as well.
Yeah, they've got to get a deal. They've got to get that vote vetting by some Republicans, 72 hours potentially. And then, of course, they've got to get it through Congress. Jill Deisis, thank you very much indeed for the latest, of course, on the debt ceiling. And that deadlock, of course, also posing a threat to emerging markets. It's a busy day for EM central banks. Indonesia's holding its benchmark interest rate for a fourth straight meeting. Later, we're going to get decisions from Turkey and South Africa. Joining us now is Bloomberg's René Valgraaf. René, what can we expect then from the South African Reserve Bank as that economy faces a multitude of challenges?
Well, Tom, the big question today will be by how much the central bank hikes. And then there'll also be lots of eyes on the guidance it gives in terms of the forecast for inflation, the forecast for its rates path, and the forecast for growth. The central bank governor, Lesetja Kganyago, he's been very vocal about government policy missteps fueling inflation and straining growth. And we may also get a bit more of that.
Renee, before the kind of hyperinflation you saw in Turkey, the Turkish lira and the South African rand was a very popular currency pair. Talk to us about the other side of that story, not the South African story, but the Turkey one. What are we expecting there?
In Turkey, all expectations are for a halt today, and that'll be continuing a stance that the central bank there has taken since around March. Now, the central bank is seeking to stabilize the lira ahead of Sunday's presidential election runoff. And some analysts say that hold move today will just be buying time. And market expectations are for a further decline in the lira, regardless of who wins on Sunday.
OK, and the Turkish lira, as we saw on the screen, they're down around 22% in the last year. Rennie Falgraf, thank you very much indeed out of Johannesburg on the impact on EM. Coming up, more on that EM story with strategist Eimear Daly of NatWest Markets. We'll get some calls from her around how to trade some of these risks. And we're going to speak to Phillip Toews of Toews Asset Management on hedging against potential risk events as that X-date looms in the US. Plus, Florida Governor Ron DeSantis officially and messily enters the 2024 presidential race. More on that campaign. That is still ahead. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York alongside Tom McKenzie in London and Edwards on assignment today. Look, it's all about the debt ceiling when you're looking at the macro stories here, although I feel like Nvidia earnings have kind of changed the tape just a little bit when it comes to just how much the debt ceiling is overshadowing the story. But let's focus on the debt for a second because it is interesting how it's playing out in the markets. The equity markets maybe focusing a little bit more on the earnings. The bond markets, 100%, it's all about the debt. For our radio audience, stick with me. We are looking at a chart here of some of the T-bills. And this is really interesting. As you can specifically see the dates that they start to expire, that June 1st T-bill already crossing a yield of about 7%. Go out to June 6th, we're at about 7% there as well. Here's my question, though. It's a no-brainer if you're worried about a default to start selling that part of the market. What happens if we avert one? How quickly does the market correct itself? That bond volatility that it feels like has been perhaps creeping back into the market, how quickly does that accelerate? Let's get a little bit more perspective here. Joining us now, Bloomberg Markets Live editor Noor Al-Ali. Noor, you are no stranger to the bond market. We've seen a lot of this volatility in the last couple of months. What happens in the unwind?
Well, look, it's an incredible opportunity, obviously, for traders that have been trying to hedge against or against the risks of the default, and then those that are playing their cards on a potential agreement. Now, obviously, here you're talking about 6-7% here. I mean, that's basically where, more than some corporate bonds that are being sold by junk-rated companies. So it shows you that there are some tensions there around those dates. But perhaps that's a reflection of maybe how remarkably low credit spreads are at the moment. So in hindsight of all of this, if we're looking at 2011 and what happened there, you saw that the dollar surged about 20% that year, even though we did approach those uncomfortable levels. So I'm looking at the dollar today and I'm thinking, that's potentially, it has room to surge further, particularly if we're also looking at the levels of real yields as well.
So the dollar gaining, again, the Bloomberg Dollar Index up about 0.1% in the session today, to your point, Noor. Talk to us about the real yield impact then. You touched on it there, and how you fold that into the views coming through from the FOMC that maybe, or at least the takeaway from the FOMC, that maybe you get a pause in June.
Yeah, absolutely. Look, I mean, if you're looking at market pricing, there's still a lot of uncertainty about whether or not we're going to get a rate hike or a pause in June. Just a couple of weeks ago, the market was expecting the Fed to cut rates as soon as June. So obviously there's a lot of adjustments here. And with real yields pushing higher now, they're extending and they're potentially going to as high as their 2022 peak, where obviously the dollar also peaked as well at that time. You can see that definitely aiding the dollar because obviously real yields pushing further above 2% is something that bodes well for the dollar. add to that market expectations of the Fed potentially holding rates at a high, at the high levels that they are, or even raising rates in July. And that is even another positive for the dollar. So obviously, as a store of value right now, the market sentiment or the narrative is shifting towards a much more bullish view towards the dollar this year.
So maybe some further upside for the dollar. Interesting, we spoke to JP Morgan Asset Management earlier. Ian Steely suggesting that he still thinks that there are cuts are going to come through from the Fed by the end of this year. So kind of pushing back on that view. But I know you've been writing about oil as well, Noor, and Brent is down around 1% in the session today. WTI at $73 a barrel after the rally that we saw on the back of the comments from the Saudi energy minister. The dollar strength, arguably a challenge for oil. Is there further pressure there? Do we look ahead to OPEC Plus and a potential cut?
Look, it's a really interesting time now to cover oil and look at OPEC. We know that Saudi Arabia has a history of trading barbs with traders, particularly against short sellers and speculators there. That's not new here. But what's really interesting is that the market is pushing back, and it puts OPEC Plus at a very unique place. Now, potentially, it could be the case where, Saudi Arabia, sent that warning of watch out to those spectators, right? To test the waters and to see if they can flush out those short sellers. But the reality of a recession, and the probability of a U.S. recession, obviously China demand still in question, really does play a big factor whether or not oil will rise this year. And it also puts into question whether or not now OPEC Plus will want to further raise their production cuts or add to the production cuts that they announced earlier this year. So there's a lot to watch for here, and that makes that in-person meeting early June that much more interesting.
Noor, I love that you brought up the OPEC story, because one of the kind of interesting dynamics I feel like the markets haven't properly explored is whether or not oil is actually trading on its fundamentals, especially in an environment where you're looking for that extra yield, where you're incentivized to take on the extra risk, whether it's through the commodity market or the EM market. Are you seeing that kind of speculative dynamic show up yet?
Absolutely. And, that's always been Saudi Arabia's point, is that paper markets, or basically the futures markets, have not been trading with, as close to the fundamentals or the supply and demand fundamentals that we see in the physical market. And that's something that you see, in terms of time spreads. You have seen now time spreads shift into contango recently in WTI. There's obviously the question as well of the U.S. The U.S. did say that they're going to start buying and refilling their reserves, when WTI hits around the 70 level. That seems to be a comfortable level. We expect that to come in sometime, in June. If that comes through, you'll see that demand. Obviously, also OPEC is expecting Chinese demand to pick up. We are seeing some numbers that can potentially help with that. But so far, the narrative, or the overarching narrative of the concerns about whether or not a recession is going to come to the U.S. globally as well, is really playing out in markets. And that divergence is really what's holding prices at a point where, I'm looking at my markets right now, Brent at around 77, WTI holding above 70. I think these levels are telling you there's still a lot of optimism, but not without caution.
Okay, the caution, the potential headwinds for this oil market and the real yield impulse for the US dollar. Bloomberg's Noor Ali, excellent. Thank you very much for walking through some of those key themes for us. More market analysis, of course. Check out MLive Go on your terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Tom McKenzie in London. Now keeping up to date with news from around the world, here's the first word. Germany has suffered its first recession since the start of the COVID-19 pandemic. Europe's biggest economy saw first quarter output shrink 0.3% from the previous 3 months. That followed a 0.5% drop between October and December. The government says lower household spending on food, clothing, footwear, and furnishings was responsible for the weak data. Bill Ackman says Hindenburg Research has, quote, outed the way billionaire Carl Icahn runs his publicly traded company. In a lengthy Twitter post, Ackman also suggested shares have room to fall after tumbling Wednesday to the lowest levels since 2009. He said Icahn Enterprises reminds him of Archegos, referring to Bill Wong's family office that spectacularly blew up in 2021. A Chinese state-sponsored hacking group has stealthily gained access to infrastructure organizations in Guam and elsewhere in the United States. That's according to a new report from Microsoft, which says the group is likely trying to disrupt critical communications in the event of a crisis. Microsoft says the hackers, known as Volt Typhoon, have been active since 2021, and Guam has become an increasingly important military and strategic hub as tensions with China ratchet up. Tom, this is your area of expertise. You spent plenty of time in China, and I'll bring my one fun fact here, which is that cybersecurity is really at the core of a lot of the tech conversation and the business investment. Your take on what Microsoft has to say.
I mean, clearly it's a discussion amongst boardrooms as well, isn't it? But Guam is a really important military base for the US as well and would be consequential in the event of any military action involving Taiwan. So that is the focus and the scrutiny for China. Plenty more coming up. We're going to get some views on these markets and some analysis, how to position amid these debt ceiling risks. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Nvidia surges. The world's most valuable chip maker hikes its sales outlook on strong demand for AI processors. The results are fueling a rally for its rivals and giving NASDAQ futures a boost. Downgrade warning. Fitch puts America's AAA rating on negative watch as House Speaker Kevin McCarthy expresses optimism that a debt deal can be reached on time. And Ron DeSantis officially jumps into the race for U.S. president. He held a Twitter Spaces event with Elon Musk last night that was plagued by technical glitches. I'm Kriti Gupta in New York with Tom McKenzie stepping in for Anna Edwards in London. Tom, a lot to digest. Then you add the political race on top of it. But I got to say, I think right now earnings might just be taking the spotlight. What do you think?
Yeah, Nvidia seems to be taking the lead here in Europe as well, and we'll delve into that story just in the next few seconds. But of course, investors, as you say, they are weighing up all of these dueling pressures, whether it comes to the debt ceiling risks, of course, in Germany, weakness when it comes to the growth picture, and on the corporate front, the optimism around AI. So that is just winning out, for the moment at least. Gains of about 0.1%, and technology is the leading sector here in Europe as a result of that. I did want to bring up the DAX over in Germany, down about 0.1%. Because of that GDP data, it confirmed that Europe's largest economy did hit a recession in the first quarter. So that does lead into the question as to whether or not the hawkish push from the ECB is really going to be sustained in that slower growth environment. Euro dollar at 107, dollar strength, of course, but again, factoring in to what extent and how far the ECB can go on rates, whether they get above 4% comfortably or not. And here's the tech story reflected in Europe, the AI impulse coming through for ASML. They are producers of these highly sophisticated lithography machines. They're based in the Netherlands. They're getting an uptick because, of course, those machines are consequential, essential in the manufacturing of these semiconductors, gaining 5% in the session so far today. Kriti.
I mean, Tom, it's a similar story here. Essentially, that got kick-started after the closing bell yesterday. Those Nvidia earnings you were just mentioning really starting to show up in NASDAQ futures, and they are soaring higher by 1.8%, more than triple the move you are seeing at S&P 500 futures, which tells you if you see green on the screen today at today's closing bell stateside, a lot of it is likely to be a tech-driven rally. That breadth may not necessarily be. There's something certainly to watch. Again, the futures higher by 1.8% for our radio audience. The 10-year yield, though, seeing a little bit of stagnation, because if the stock market is focused on earnings, the bond market laser focused on the debt ceiling debate and the developments there, especially now that Fitch has put the U.S. credit rating on that triple wash. 10-year yield hovering at about 376. What happens when we get closer and closer to 4%? More importantly, what happens in the unwind once this saga ends? Bloomberg Dollar Index as well, taking its cue from the bond market. No major reaction in the FX space. Those interest rates are really going to drive the currency picture. What's interesting to me, though, is already as you see us getting closer and closer to the X date, which again, maybe anywhere between June 1st and June 15th, you are starting to see that bid in gold come back in. So you are seeing 1963 on the precious metal higher by about 0.3%. Nothing to write home about, but really watch this space as we, again, head towards those opening bells. But I think the question is, what's the trade? How do you hedge it? Who better to join us than Phillip Toews, President and CEO of Toews Asset Management. Phil, thank you for waking up early for us, folks. What you need to know about Phil is that in the last global financial crisis, this is the guy who knew how to hedge it, one of the best performing strategies in that era. So if you're worried about a downturn, this guy knows how to tell you or how to navigate it. Phil, let's get very simple. What's the trade? What's the hedge?
Okay, so, we looked at a lot of history as we started to come up to this event. About a month ago, because you've got 2011 and 2013 and a lot of historical precedent about how markets look leading into debt issues like the one we're experiencing right now. So we looked at things like gold that you were mentioning. We looked at treasuries. We looked at VIX options, which gets a lot of play because everyone's thinking about potentially a VIX surge. But what we realized is that with volatility as low as it has been, and frankly still is, put options on the stock market, and in particular just the S&P 500, are super reasonable, and it doesn't make sense to us. So, because what you want, Kriti, is you want something in your portfolio that's going to appreciate if everything goes badly. And look, the thing that's so surprising to us is that everyone remains so, basically the markets are not acknowledging, even still, a couple of down days in the last, this week, but they're really not acknowledging in any meaningful way the reality of what we may face. So we like put contracts. We took across our equity funds and ETFs, and we added extra protection in the case that there could be a downturn in the markets. In my own personal accounts, I'll have to disclose I bought about 38 million notional in put options betting against the market. That'll be a limited cost across all of our funds and our ETFs. So we think that you need to make the action, make the move now in the case things roll over. And we think that will happen soon, obviously.
Interesting. Betting against the market. But Phil, I mean, look at these Nvidia earnings after the bell. Already you're seeing NASDAQ futures higher by 1.8%. What do you make of this AI craze now that actual money is being put to work in this field?
Yeah, so it's working in terms of certainly revenue and profits for certain parts of the market. I think we just have to say, I was just speaking at the Inside ETFs conference here in Miami, where I still remain, and no one is really thinking about or talking about the debt issue. I think it has to be the focus right now. It's sort of like the apartment building's on fire. Should we do something about it, or should we refreshen our cocktails? That's how we feel about it. And so I think all eyes need to be addressing that. I think it's time for investors and advisors to make the focus. Another simple button for investors to make is just move into some hedged equity funds or ETFs that have some options as a part of them and address that. Yeah, we're surprised. I look at the futures coming into the open today. We're looking at only less than a week before potential X date. So yeah, I think people need to stay focused on that.
Phil, you're counter consensus again, because the equity markets just want to talk about Nvidia, and you're bringing it back to the debt ceiling. So you're talking about putting in place those put options and how to hedge around this event. And you're making the call, arguably as well, that the politics are different this time round, because almost everyone we speak to says, look to 2011, they got it across the line. But you're saying 2011, in terms of the politics, that's the wrong heuristic to look through.
Well, first of all, if you look to 2011, where they did get it across the line, we saw peak to trough drops of 20% and a lot of chaos and damage to the economy. So that's our base case right there, is that you can say that the deal gets done, but we all know that the market can be massively damaged in the lead up to that. Now, in 2011, it happened very quickly, too. So there was basically no acknowledgement in the markets that anything was going to happen. And then within a 2-week period of time, the markets just completely rolled over. So that's what we're watching for right now. Another thing to think about or frame this is that you think about probabilities and consequences, right? So you can argue about what the probability is that we either get very close and damage the markets or actually go into default. But no one really is arguing about the consequences, where you're looking at treasuries, which are the oxygen to the financial system, and the question there is, how long can the financial system go without oxygen? It's a place that we just don't even know what the consequences would be. So yeah, we're really focused on that. But going back to the politics of what you're talking about, in 2011, we did not have parts of the party that actually were saying, yeah, default might be okay. So as far as the Freedom Caucus, they would probably rather see us go into default than make some kind of unwieldy compromise. And certainly the Progressive Caucus is not going to be that desirable. They're talking about the 14th Amendment, so they're sort of looking now to workarounds already. So can you ram it down the middle? That would be amazing. Like if you could just marginalize the people on the margins and get this done, that would be maybe a new roadmap for what happens with the administration and the legislature. But I don't know. I think the probabilities are higher than people are acknowledging that we have some real problems ahead.
Phil, is there a barbell approach to take as well, as you kind of position maybe for the upside in any relief rally, should and when they get this across the line?
Yeah, so I think you do have to position for either, contingency. So for example, inside of our equity funds, we don't have any calls written. And, the amount of extra spend we did on options was in the range of something like between, 25 to 30 basis points, right? So it's not a huge spend that could have a huge payoff. We looked at, if you look at the cost of options, we would see a 40x return on the cost of the options if 2011 played out. But what if the markets move higher inside of that same strategy? As long as you're staying invested, you just have that small fixed cost to protect portfolios, but then you're going to rally higher along with the market. So I think that this basic approach of having a limited spend, and by the way, it's not too expensive still. I mean, if you wanted to deploy that, or if you wanted to move into hedged equity funds, we're up year to date, it would be a relatively painless transaction where you'd know what the cost would be ahead.
Okay, really, really smart. Load up on those put contracts, and the risks around this event are not being taken into account fully. Is the view, of course, from Phillip Toews of Toews Asset Management. Really smart. Thank you for your time and breaking it down for us, how to position around these risks. Coming up, we're going to hear and speak to Eimear Daly, the emerging market macro strategist at NatWest, on the EM impulse, and some calls coming through there as in terms of how to trade some of these EM FX, again, in this volatile environment. Stay with us. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with Kyle Bass, Heyman Capital Management CIO. That coming up at 10 a.m. New York, 3 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London with Kriti Gupta in New York. Now, emerging market central banks are facing the twin spectres of inflation and a repricing of Fed rate hike bets and significant domestic risks. Joining us now to take a closer look is Eimear Daly, emerging market strategist at NatWest. Eimear, we can talk about the carry trade, we can talk about the Fed minutes and how positioning around the dollar is going to impact some of your calls. Do you need a weaker dollar to make some of your calls around EM come to the fore? Is there an expectation that you're going to get softness in the US dollar? Looking at gains today on some of these risk haven moves, and the real yield story is true for the greenback. But do you need weaker dollar for some of these EM plays to come through?
I mean, a weaker dollar definitely helps, but I think there is still significant carry available in EM. And I think, investors are historically underinvested, and we've really seen kind of credible central bank policy coming out. So I would say, selectively bullish EM, but I think there are some great kind of growth stories coming through in EM, and really places that really offer investors an attractive scenario and a lot of return.
Do you have to put the commod producing EM into a separate basket, given the slowing growth impulse out of China?
It's interesting because we've actually seen some of those commodities producers perform really well and actually, outperform what's happening in commodities. And I would say it's really the central bank story that's really driving it. It is all about
they got ahead of the curve in terms of the rate cut.
They got ahead of the curve. And I mean, if you look at you've already seen this structural correction coming through. We've seen, trade balances go back into surplus when they were deficits. We have seen, inflation really come off. And I think it's worth saying that, these are emerging markets. They're, by definition, poor. So food, energy prices are a bigger component of their CPI basket. So you will see inflation coming down a lot faster in these economies. And yet their central banks have been really hesitant to hike on any kind of easing bandwagon. They're really being cautious. They're really guaranteeing investors return and carry.
Eimear, Kriti Gupta in New York. Talk to us a little bit about the risk-taking here, because it feels like from a more macro view when it comes to EM, there is this incentive that as soon as the debt saga is over and this kind of dollar trade unwinds, EM has a lot to benefit. Do you already see anyone kind of getting ahead of that trade?
I think there are some great kind of stories within EM. So, for example, Czech Koruna has been one of our kind of outperformers. We've got FX interventions, so basically investors are backstopped from any kind of currency depreciation. It offers significant carry, and you've got a central bank that basically was one vote away from actually hiking. I would say that investors are probably not really playing the US debt ceiling so much. I feel like they're kind of waiting on the sidelines, but they are kind of doing bottom-up stories where, you kind of focus on relative value. I think we're probably shifting away from kind of a global investment environment, which is just dominated by the US, and we're looking at more kind of idiosyncratic national stories.
Well, speaking of one of those idiosyncratic national stories, one of your highest conviction calls here, shorting the South African rand relative to the Brazilian real. Why Brazil?
Brazil offers you great carry. So I guess like when you're shorting an emerging market currency, you want to do it against something where you have positive carry, so you still get a significant return. We think that, domestics are improving in Brazil, and it's probably the other side of the coin in South Africa, where South Africa is one economy where you've actually seen its current account actually return to deficit when it did kind of enjoy a terms of trade boost. And I think probably what's most prevalent and the biggest story in South Africa right now is these accusations that it actually armed Russia and the risk that you could have US retaliation. Just to put it in context, most kind of US sanctions we've seen when it comes to the Russian conflict really relate to kind of dual-use technology, which is that you will get sanctioned if you send a kettle or a radiator to Russia that contains a chip that they could use in weapons. South Africa is actually accused of basically having a boat dock in its main naval base and being uploaded with explicit weapons, which are being sent to Russia. So it is a much more grave accusation, and we do think there is significant risk of economic damage to South Africa because of it.
Yeah, it's a really remarkable geopolitical story, isn't it? I mean, even China hasn't, as far as we know, sent weapons to Russia, but South Africa, it seems, or at least has been accused of doing so. And the war, Russia's war in Ukraine, ties into your views on the zloty as well, the Polish zloty, but kind of counterintuitively, you think it gets further upside. You're long the zloty versus the foreign. This is the Eastern European trade for you.
Yeah, absolutely. I think Poland really stands out as one country that's been the massive support for Ukraine. It's really kind of led calls to provide humanitarian aid and to provide it with military supplies. Obviously, the big thing for Poland is this standoff over EU funding, so up to 75 billion euros it's waiting to receive from the EU. And the interesting thing is that there hasn't been that many developments, and we really think from the EU side they're waiting to see who wins the next parliamentary election. They don't know who they're going to be negotiating with in the long term. We think it is the incumbent, but we think the massive thing is just getting through those elections. The EU will then, kind of approach the new government with more kind of urgency to sort this out. And I think it's really kind of relevant to say that obviously Poland is a NATO country. They're covered by Article 5. So, if any kind of weapons spill across that border, you need Poland to be kind of very kind of astute in how they respond to it.
Eimear Daly of NatWest. Really, really interesting calls coming through in terms of the emerging markets of Eastern Europe, but also in terms of what is happening in South Africa and the geopolitics, how that ties into the rand. Short the rand versus the Brazilian real, long the zloty versus the Hungarian forint. Thank you very much indeed, Eimear. Now, coming up, the GOP race to 2024 is heating up.
Truth must be our foundation, and common sense can no longer be an uncommon virtue. In Florida, we prove that it can be done. I'm Ron DeSantis, and I'm running for president to lead our great American comeback.
Florida Governor Ron DeSantis making his bid official on Twitter. More on that next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London with Kriti Gupta in New York. Now, look at what is ahead today. We get interest rate decisions in Turkey and South Africa. The focus on EM then. A host of US data at 8:30, including GDP, core PCE, and initial jobless claims building out the picture after the FOMC minutes suggested that maybe the move is towards a pause in June. And later today, we're going to hear from Richmond Fed President Tom Barkin and Boston Fed President Susan Collins on whether or not they give further details on their thinking in terms of the rate hike trajectory for the Fed. Ron DeSantis officially, of course, launching his long-awaited 2024 presidential campaign. Kriti.
Yeah, a lot happening last night. He tries to take the Republican nomination away from former President Trump. And get this, he did it to Twitter Spaces, an event with Elon Musk that was beset by technical glitches. Joining us for all kind of the story and how this all played out, because it was kind of messy. Madison Mills joins us on set, wakes up early to walk us through the chaos. Madison, what stood out to you? How did this even come about?
Well, it's so interesting, Kriti, because in all of the coverage, you would hope as a presidential candidate that it would be the headline, you know, Ron DeSantis running for president, but all of those headlines are accompanied by those Twitter space glitches, right? So there was a lot of volume, a lot of listeners on the platform, and that caused the Twitter space initially to crash, but eventually they got back on board and he did announce his official run for president. Now, he focused on the key issues that we've heard from him throughout his reign as governor of Florida, right? He talked about the culture wars, being tough on crime, focusing on the border. And what's really interesting to point out, and I got a lot of sources talking to me about this when I was on the ground in Florida for the midterms, is that voters see him as the drama-free Trump. And even though he's definitely trailing Trump when we look at the polling data, he's definitely the most formidable opponent to Trump at the moment. So the question is going to be whether or not he's going to be able to take the successes that he's had at the state level in Florida and transition those to the national level.
Yeah, well, he wasn't drama-free yesterday, was he, given all the glitches? That we've been waiting for this for months, Madison. As you know, you've been on the ground, you say, reporting from Florida. Yeah. They must have given this some thought in terms of how they were going to make this announcement. So what was the rationale for teaming up with Musk and doing this on Twitter?
Yeah, it's a social media play, right? And some of the, campaign folks that I've spoken with have talked a lot about this being a really smart strategy to reach voters in a national way, international way, that is on a platform that's very accessible. But as we saw last night, those technical glitches somewhat diminishing the headline there. I think the big thing to look at, though, when it comes to the Twitter story is what it tells us that Elon Musk was willing and excited about hosting DeSantis on the Twitter platform and what that's going to mean for advertisers on the platform moving forward. We know that DeSantis and Disney are in a very public fight over theme parks and the Don't Say Gay bill in Florida. And Disney is one of Twitter's biggest spenders when it comes to advertising. So that's going to be critical to watch as we head into the election and kind of monitoring Musk's commentary on all of the candidates.
Madison Mills all over the story of, I would say, the 2024 election, the Twitter story. This is kind of market, technology, politics, all in one. Madison Mills, we thank you as always for waking up early and bringing us that context. I want to get to some pre-market movers here because, look, it is a tech-driven rally already in this session. A lot of this coming off of Nvidia's pretty strong earnings. Their second quarter forecast enormous, almost 1.5 times the analyst estimate of what that kind of growth is supposed to look like in the second quarter. It's not alone, though. It's taking with it the other likes of its peers. AMD higher by 8.7%, Micron higher by just 5%, but really dwarfed next to Nvidia's 26% gains in the pre-market. Folks, stick with us. This is going to be an interesting session. That's it for early edition. Surveillance is ahead. Larry Adams of Raymond James, Kathy Jones of Charles Schwab, and Jay Bryson of Wells Fargo. Join Tom, John, and Lisa in just a moment. Stick with us. More surveillance ahead. This is Bloomberg.